Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Bristol-Myers Squibb Company annual report. Bristol-Myers Squibb Company offers a wide range of biopharmaceutical products across various therapeutic areas. The company's portfolio includes treatments for cancer, such as Opdivo, Yervoy, and Opdualag, which are used to combat solid tumors, melanoma, and other types of cancer. In addition to oncology products, the company also offers medications for autoimmune diseases like rheumatoid arthritis, Orencia, and multiple sclerosis, Zeposia. It also has treatments for cardiovascular conditions, including Eliquis, which reduces the risk of stroke and systemic embolism in non-valvular atrial fibrillation. The company's products also extend to immunology, with medications such as Abecma and Revlimid used to treat multiple myeloma. Furthermore, it offers treatments for neurological disorders like schizophrenia, Cobenfy, and plaque psoriasis, Sodiq-2. In the area of hematology, Bristol-Myers Squibb Company provides Reblozyl to treat anemia. The company also has products that target specific genetic mutations, such as Krazati, which is used to treat NSCLC with a KRASG12C mutation. The company sells its products to various customers, including wholesalers, distributors, specialty pharmacies, and retailers. Its products are also available to hospitals, clinics, and government agencies. With a history dating back to 1887, Bristol-Myers Squibb Company has established itself as a leading player in the biopharmaceutical industry. The company's portfolio includes several notable products, including oncology, Opdivo, Yervoy, Opdualag, autoimmune diseases, Orencia, Zeposia, cardiovascular conditions, Eliquis, immunology, Abecma, Revlimid, neurological disorders, Cobenfy, Sodiq-2, hematology. Reblozyl, specific genetic mutations. Krazati. These products are sold to various customers, including wholesalers, distributors, specialty pharmacies, and retailers. Bristol-Myers Squibb Co., BMY, has experienced a significant stock price increase of over 12.48% in the past year, with a total return of 15.13%. This growth can be attributed to several positive news events that have driven investor confidence. One major factor contributing to this increase is the company's strong financial performance. In its Q4 2025 earnings report, Bristol-Myers Squibb exceeded analyst expectations, with an adjusted EPS of $1.26 and revenues of $12.5 billion. This was largely due to the success of its growth portfolio, which includes newer products such as Opdivo and Reblozyl, and saw a 15% year-over-year revenue increase. In addition to its financial results, Bristol-Myers Squibb has also made significant strides in strategic advancements. The company has partnered with Evanova to optimize clinical development through AI and with Microsoft to advance early detection of lung cancer using AI. These collaborations demonstrate the company's commitment to innovation and its ability to adapt to changing market trends. Furthermore, Bristol-Myers Squibb's robust product pipeline and cost savings initiatives have also contributed to its stock price increase. The company has achieved $1 billion in cost savings in 2025 and is on track to meet a targeted $2 billion productivity initiative. With several pivotal clinical data readouts expected for at least 6 products, investors are optimistic about the company's future prospects. Overall, while Bristol-Myers Squibb faced some challenges, including generic competition and a phase III trial failure, its growth portfolio, strong financial performance, and strategic initiatives have outweighed these headwinds, leading to a notable stock price increase. Bristol-Myers Squibb Company market capitalization of $122 billion is materially smaller than most of its industry peers, of roughly $255 billion. Bristol-Myers Squibb Company trades at a lower price-to-earnings ratio of 17 times and a higher price-to-book ratio of 6.58 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 82% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 4.2%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. On the growth side, upfront fees and milestone payments from partnerships have been a significant contributor to revenue increases. Additionally, royalty income from licensed products has also played a crucial role in driving revenue growth. Furthermore, contingent development, regulatory, and sales-based milestones have provided an additional boost to revenue. On the other hand, generic competition has been a major driver of revenue decline for several companies. Patent infringement actions and settlement agreements have also led to significant declines in revenue. Mandatory discounts or pricing protection below wholesaler list price in government programs have further exacerbated this trend. Decreased royalty income due to transfers of future royalty rights has also contributed to revenue decline. It is worth noting that foreign currency exchange contracts, forward interest rate contracts, and unrecognized compensation costs can also impact revenue growth or decline. Regional drivers such as decreased U.S. federal net operating loss carryforwards and increased U.S. defined contribution plan expense have also been observed in certain companies. The net income of a company underwent significant changes between 2023 and 2025. Initially, it decreased from 2024 to 2025, indicating a decline in profitability. However, when comparing the data from 2023 to 2025, there was an increase in net income, suggesting that the company's financial performance improved over this period. The profit margins of the company also experienced a decrease due to various factors. One major reason was the increased competition and pricing pressure, which forced the company to reduce its prices and reimbursement for certain products. Additionally, government regulations such as the Inflation Reduction Act, IRA, imposed further constraints on market access and profitability. Higher operating costs, including rising inflation rates and wage increases, also contributed to the decline in profit margins. The reasons behind these changes are multifaceted. Government regulations and market access constraints played a significant role in affecting the company's financial performance. Increased competition and pricing pressure also had a substantial impact on the company's profitability. Furthermore, the loss of market exclusivity or other factors affecting key products contributed to the decline in profit margins. Overall, these factors combined to result in a decrease in net income and profit margins over the specified period. The company is indeed generating positive operating cash flow. This can be seen in the various financial statements and reports that consistently show a net inflow of cash from operations. On page 65, it is stated that the company generated $14.2 billion in cash provided by operations for the year 2025. Similarly, on page 67, the operating cash flow for 2025 is reported to be $14,156 million. This trend continues throughout the financial reports, with page 80 showing an operating cash flow of $24,119 for 2025, and page 81 confirming a net cash provided by operating activities of $14,156 million. The consistency in these figures across different pages suggests that the company is generating significant positive operating cash flow. This is further reinforced on page 90, where it is reported that the net cash provided by operating activities was $15,035 million for 2025. Overall, the evidence points to a strong and consistent generation of positive operating cash flow by the company. But the company's debt level and interest expenses have undergone significant changes over the past year. On page 65, it is noted that the net debt position decreased by $4,427 million from 2024 to 2025, indicating a reduction in overall debt. Additionally, long-term debt also saw a decrease of $4,753 million during this period. However, on page 66, it is mentioned that there was a repayment of notes at maturity worth $1.9 billion in 2025 and $2.9 billion in 2024. This suggests that the company has been actively paying off its debt, which could be contributing to the decrease in net debt position. Regarding interest expenses, page 64 indicates an increase of $19 million from 2024 to 2025, with a total interest expense of $68 million in 2025 compared to $49 million in 2024. On the other hand, page 96 shows that interest expense decreased by $56 million from 2024 to 2025. It appears that there is some discrepancy between the different pages regarding the change in interest expenses. However, it can be concluded that the company's debt level has decreased significantly over the past year, with a reduction in net debt position and long-term debt. The performance of different segments and regions is a crucial aspect of any business's success. According to recent data, it appears that the U.S. segment has been performing exceptionally well. This is a positive sign for the company, indicating strong growth and revenue generation in this key market. On the other hand, non-U.S. business operations have faced significant challenges, leading to poor performance. Various factors are contributing to these difficulties, which need to be addressed promptly to prevent further decline. The disparity between the U.S. segment's success and the struggles of non-U.S. business highlights the importance of regional diversification and tailored strategies for different markets. Management is optimistic about the company's outlook, emphasizing its focus on developing transformational medicines across various therapeutic areas. The company prioritizes science, execution, and value in its R&D strategy to drive long-term growth and shareholder returns. To achieve this, management aims to drive operational excellence, invest in artificial intelligence, and strategically allocate capital. The company is also expanding its leadership in immuno-oncology, IO, and diversifying beyond IO, while establishing a strong foundation in multiple areas such as hematology, cardiovascular diseases, cell therapy, immunology, and neuroscience. Management plans to develop novel therapies for patients and drive sustainable growth through strategic allocation of resources and investing in high-value areas. In addition to its R&D strategy, management highlights the importance of commercial execution of key marketed products and cost savings from strategic productivity initiatives. The company is also benefiting from new tax legislation, which allows for immediate deduction of qualifying domestic R&D expenses and acceleration of deductions for deferred domestic R&D expenses. Overall, management statements convey a sense of confidence in the company's ability to drive long-term growth and shareholder returns through its focused strategy and investments. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased various pharmaceutical products and companies, including Eliquis, Opdivo Qvantig, Orentia, Reblozyl, Yervoy, Mirati, Karuna, RayzeBio, and U.S. federal net operating loss carryforwards worth $1.3 billion. These acquisitions are expected to enhance the company's product portfolio and revenue streams. On the other hand, the company has also divested its diabetes business as of December 31, 2025. This move is likely aimed at streamlining operations and focusing on core areas of growth. The divestiture of the diabetes business marks a strategic shift in the company's priorities and will allow it to allocate resources more effectively towards other high-potential opportunities. The company has a history of rewarding its shareholders through various means. One way it has done this is by paying dividends. According to the report, the company has indeed paid dividends, as confirmed on page 68. This indicates that the company values its shareholders and is committed to returning value to them. In addition to paying dividends, the company has also taken steps to reduce the number of outstanding shares. Specifically, it has bought back shares through a program known as BMS Repurchased. As stated on page 120, the company repurchased 70 million shares for $4 billion. This move not only reduces the number of shares in circulation, but also increases the value of each remaining share, benefiting existing shareholders. That concludes the financial summary for Bristol-Myers Squibb Company. Feel free to comment below, and I will be happy to answer them when possible.